Hey everyone, welcome back to Corporate Decoder. Today, we're diving into a report from Hyperscale Data, and let's just say their financial situation is more tangled than a plate of spaghetti after a toddler's had their way with it. Get ready for a roller coaster. So this is an 8K filing, which is basically a company's way of saying, hey investors, something important just happened. And in Hyperscale Data's case, that important thing is all about debt and trying to keep the lights on. The main story here revolves around something called a forbearance agreement. Think of it as a financial timeout. Hyperscale Data was struggling to repay some debt, so they made a deal with their lender and investor to delay repayment. Basically, they asked for more time to come up with the money. To understand what's going on now, we need a little backstory. Back in July of last year, Hyperscale Data took out a loan by selling a note. This note was for about $5.4 million, but they only received $4.9 million upfront. That's because it was a 10% OID convertible promissory note, which means they got less money initially, but the total amount they owe is higher. This note was due in October, but they couldn't pay it back then, so they had to make another deal. The first time they couldn't pay in December, they entered into a forbearance agreement. This agreement gave them a bit more time to pay. In exchange, they issued another note to the investor for about $850,000. This is like taking out a smaller loan to delay paying back the bigger loan. It just kicks the can down the road. Now here we are in February and they're doing it again. They've entered into an amended and restated forbearance agreement, or A&R forbearance agreement. This gives them until May to avoid defaulting on the original debt. The investor is giving them more time, but it's not free. This time, they're issuing a new convertible promissory note for a whopping $3.5 million. This new note covers a few things. First, it covers the amount due from that earlier forbearance note, which is about $888,000. Then, they're paying almost $312,000 as a forbearance extension fee for the investor to extend the deadline. And finally, it includes an additional $2.3 million, which they call a true-up amount. It's all rolled into this big new debt. This new note can be converted into shares of Hyperscale Data's stock at a price of $2 per share. However, there's a catch. They need to get approval from the NYSE American, which is the stock exchange where they're listed, and from their stockholders. The A&R forbearance note will accrue interest at the rate of 18% per year. That's a pretty steep interest rate, and it shows just how risky the lender considers Hyperscale Data to be. The note matures or comes due in May of this year. Like any loan, this one has default clauses. If Hyperscale Data fails to make payments, breaks promises, goes bankrupt, or gets kicked off the stock exchange, they'll be in trouble. Scroll creation of a direct financial obligation / scroll. Basically, they are creating a big direct financial obligation. They are responsible to pay for it. The sale of this note didn't go through all the usual registration processes with the Securities and Exchange Commission, or SEC. They are relying on an exemption, meaning they think they don't have to register it because of certain circumstances. Now let's step back and look at the big picture. Hyperscale Data is in a tough spot. They couldn't repay their debt last year, and they're having to take out more and more expensive loans just to buy themselves time. This isn't a sustainable situation. The high interest rate and the need for stock exchange and shareholder approval to convert the debt into stock show how precarious their financial position is. The biggest risk for investors is that Hyperscale Data might not be able to repay all this debt. They're relying on getting approval to convert the debt into stock, but that's not guaranteed. If they can't repay or convert the debt, they could face serious financial consequences, including bankruptcy. The problem with this, aside from the fact that it means that they have a lot of debt, is that it means they will probably have more debt to pay for this debt down the line. So what's the verdict on Hyperscale Data? Well, it's not looking great. The company is clearly struggling with its finances, and these repeated forbearance agreements are a red flag. While there might be some potential opportunities down the road, the risks seem to outweigh the rewards right now. Thanks for watching. If you found this breakdown helpful, give us a like, drop a comment, and definitely subscribe for more corporate deep dives. See you next time.